Welcome everyone. This is the Tuesday's Lunch and Learn for Strata with the Condominium Homeowners Association. Thanks for joining us. This session is being recorded and it'll be on the website tomorrow, so you will be able to access it again in the future. Thanks to all of our CHOA members across the province for your continued support and your membership. And if you're not a member, you might want to contact the office and consider being a member. Many thanks to BC Housing and the provincial government for their continued support and their partnership. They really have been essential in helping all of our organizations get through this crisis, and a lot of thanks to them for that. And of course, we welcome Alison Baker today, and a lot of thanks to her for teaching this session. We'll monitor and hold questions to the end of the session, and at the end of the recording, as we come to the end, when we stop the recording, we will stay online and continue to answer some questions at that point, but we won't go any further than 1 o'clock as we get through questions. And of course, use the Q&A for any questions that you might have. If you have additional questions, please email info@choa.bc.ca. So without any more delay, I'm just going to open up our presentation and share the screen, and Alison will be away here. So Alison, they're all yours.
Hi everyone, welcome to Tuesday's Lunch and Learn. This is a new forum for me, so we'll see how it goes. Many of you may have seen me speak on insurance matters in the past for CHOA. It's obviously become an even more important issue, or a more top of the mind issue, because of the issues in British Columbia that we've been facing over the last, I'm going to say 12 to 18 months involving Strata insurance. So as Tony's already said, this webinar is being recorded. We're going to ask that questions be, we're going to deal with the questions, or some of the questions, at the end. If you do have any questions, please don't include any identifying information about your particular Strata plan or business, or any personal information, either in the chat or in the webinar. As I said, we're going to have a session at the end for questions, so feel free to send them in as they occur to you. So over the last 12 months or so in British Columbia, British Columbia has felt, I guess, somewhat of an earthquake in terms, hate to use that term, but in terms of insurance. A lot of Strata corporations, and I have to say this is somewhat personal to me because I live in a Strata corporation myself, and we've gone through this. We've had sticker shock over the significant increases in premiums, significant increases in deductibles, and at the same time, we're also seeing less insurance coverage for a lot more money. And we often get asked the question, why is this happening? Well, there's a large number of reasons. I'm not an insurance broker, I'm not an underwriter, I'm a lawyer, but I do give advice to Stratas. I've heard a number of people in the insurance industry speak about what the problems are. Some of them are global. The insurance market generally has become what's called a hard market, which means that there's less capacity in the insurance market to insure. That means that there's less appetite. With fewer insurers, they're looking for more security in terms of their investment, because they view placing insurance as somewhat of an investment for them. And so they're trying to deal with managing their own risk, and that means looking more carefully at the buildings that they are insuring and the return on their investment. That has meant particular impact for larger Strata corporations in British Columbia, and by that I mean bigger buildings with higher full replacement values. So larger concrete developments or larger townhouse developments, less of an impact in smaller Strata corporations, although that may be mitigated at the same time by the fact that some of the smaller Strata corporations, as is the case with any Strata corporation, may have had a negative claims history, as in many insurance claims for that particular complex. So that's sort of the bigger picture. There's also some very specific issues that come up in British Columbia because of the way our legislation is currently drafted. So I'm going to turn now to what the agenda for today's meeting is. In order to have an understanding of some of the insurance issues we're dealing with, I'm going to do a bit of a walkthrough through the basic principles of property damage insurance coverage as required by the Strata Property Act. That's the primary driver for the large increases in insurance deductibles and insurance premiums and reduced coverage, less so on the liability side, so I'm not going to speak at all about that today. Then I'm going to go into a bit more detail about what the impact of the hard market has been on strata corporations and some of the issues that they're dealing with as a result. And then the third area is risk management and the kinds of things that strata corporations should be looking at to try and make themselves more attractive as an insurance risk, and also potentially ways to try and address insurance premiums and deductibles. So as a starting point, under the Strata Property Act, there is a part of the act that deals specifically with the requirements for strata insurance. And Section 149 is the key provision when it comes to property damage insurance. It identifies what the strata corporation is required to insure. And as a starting point, that is all common property of the strata corporation is to be insured by the strata corporation. All common assets of the strata corporation are to be insured. And in the non-bare land situation, which is any strata corporation that is not a bare land strata plan, the strata corporation is required to insure the original fixtures in a strata lot that were installed there by the owner developer. That is one area where BC varies from other provinces, and it's probably the most significant, which is in BC, the strata corporation insures strata lots as they were originally constructed by the owner developer, including fixtures, and I'll talk a bit more in a moment about what fixtures consist of. That is not necessarily the case in other provinces, particularly as a comparison, Ontario and Alberta, and is one of the contributing factors to why we are seeing much larger increases in insurance premiums in British Columbia than is generally the case in other jurisdictions in Canada, including Ontario and somewhat Alberta. Alberta has had some examples of significant premium increases, but it doesn't seem to be quite as widespread as British Columbia. So what is the Strata's insurance, property insurance expected to insure against? Those are what are called perils. So a peril is a cause of a loss, and the Act, in conjunction with the regulations, identifies specific major perils that the Strata Corporation is required to take insurance, property damage insurance out against. And again, I'll talk a bit more about those in a moment. And then for what? The Strata Property Act says that the property damage insurance coverage is to be to full replacement value. And this is one of the issues that has created a lot of challenges for strata corporations in many cases, particularly larger ones where there are capacity issues, meaning that the insurers or the strata corporation's broker is not able to fully insure or place insurance to fully insure to full replacement value standard. And I'll talk a bit more about that. And then finally, Section 155 of the Act identifies who is an insured on the strata corporation's insurance policy. And the Act identifies, obviously, the strata corporation is, because the strata is the party that's taking out the insurance. But it's important to keep in mind that the strata is doing that as essentially a facilitator of insurance coverage to make sure that in the event of a significant loss to the building, either a fire or an earthquake or water damage, that there is going to be insurance coverage. But at the end of the day, the strata corporation doesn't own the common property, it doesn't own the common assets, it doesn't own the strata lots. It's the owners that own all of those things. So the strata corporation is taking out insurance on behalf of the owners to ensure that there will be coverage in place when an insurance, when a damage claim arises. So as a result of that, the Act specifically identifies that owners are to be named insureds on the Strata Corporation's insurance policy. And that gives owners the certain rights to make claims against the insurance policy where an insurance claim does arise. So I just mentioned that part of the Strata Corporation's insurance coverage is required to insure original fixtures in the strata lot. So what is a fixture? That's defined by section 9.1 of the Strata Property Regulation. And it's basically anything that's attached to a building. And the Act or the regulation specifically states that it includes flooring, includes wall covering, includes electrical and plumbing fixtures, but does not include items if they can be removed without damage to the building, things like refrigerators, stoves, microwaves, essentially appliances and other items. So if you can easily detach it without damaging the building, it's not identified as being a fixture within the meaning of the regulation. So things like the ceiling of a strata lot, the drywall in a strata lot, the flooring, whether it's carpeting or hardwood, if it was originally installed by the owner developer, that is covered by the Strata Corporation's insurance. If the strata lot has a furnace in it, if the strata lot has a heating tank in it, the kitchen cabinets, the sinks, the plumbing fixtures like the tubs and the toilets, all of those items, if they are attached to the building, which they are in pretty well every case, they will be considered a fixture that is insured by the Strata Corporation. Lighting fixtures are included there. Whether a lighting fixture is or is not is going to depend on the level of attachment to the building and whether it can be removed easily or not. So the next piece of the puzzle in terms of what the Strata Corporation is required to insure for is the specified major perils. Those are identified in also in section 9.1 of the Strata Property Regulation. That is the list of items there. So fire, an obvious one, explosion, water escape. I highlight that because that is probably one of the biggest contributing factors to the number of insurance claims we tend to see here in British Columbia. Lightning strikes, riots, civil commotion, impact by aircraft or vehicles, vandalism, and malicious acts. Now, interesting, what's not included on that list, 2 perils that stratas often get and should be considering when they're getting their insurance coverage. Earthquake is not mandatory in British Columbia, and sewer backup is not mandatory in British Columbia. So each strata corporation is going to have to consider for itself what perils, optional perils it will cover. And that is not intended to be an exhaustive list. It's just intended to be examples of typical perils. So what is the impact of a hard market? So insurers are always going to be looking at certain factors in deciding the terms on which insurance is either going to be placed in the first place or it's going to be renewed. But now it's becoming even more important in terms of determining the extent of the coverage that can be made available to the particular strata corporation, the amount of the insurance premium, and the amount of the deductible that the strata corporation or may be payable in the event of a claim. So some of the factors that are taken into account, and this is what underwriters do when they're determining coverage, extent of coverage, premiums, and deductibles, is the age and condition of your complex, your claims history, how many claims have you had over a specified period of time. It may be a 3-year period, a 5-year period, a 10-year period. It all depends on the underwriting practices of the particular insurers and what they're going to be looking for. The replacement value of the property, as I mentioned earlier, larger strata corporations are having a harder time in the current market because of limited capacity to take on insurance risks. And then things like the location and exposure to flood and earthquake. Are you in a part of the province that is more prone to flooding or considered to be more of an earthquake risk than other parts of the province, or even in the lower mainland? So the first area, or one of the areas that we're seeing an impact on arising from the hard market, is the extent of coverage that may be available. So as I mentioned at the outset, one of the provisions of the Strata Property Act on property damage insurance is that the insurance is to be to full replacement value, and it's sufficient insurance coverage to allow for a reconstruction of the buildings following a catastrophic loss. For many years, when we had what was called a soft market, meaning there were lots of insurers and lots of competition, strata corporations not only were able to get full replacement value, which essentially allows reconstruction of the building to its original, but also allowed for supplementary coverage to deal with what happens if you have an insurance claim. And since your building was built, there have been amendments to the building code, meaning, for example, now you had to put in a sprinkler system, or the cladding system in the building had to be changed to rain screen. All of that has gone away. It's very difficult, if not impossible now, to get that kind of additional coverage. And it's now become even more challenging, and some stratas are not able to get full replacement value. Now, for those of you who've attended some of the seminars that I've done in the past, I've spoken about what's called underinsurance and co-insurance. So on a full replacement value policy, the expectation is that the strata corporation is insuring to full replacement value. Underinsurance and co-insurance comes about when the property is being insured to less than full replacement value, even though that's the premise of the policy. Where there is a co-insurance clause, the insurer is only going to pay a portion of the claim if the identified limit in the policy for minimum coverage is not reached. And on the next page, next slide, I give an example of how that works. We have a strata complex, in this case, as an example, that's their full replacement value is $25 million. However, the strata has not been obtaining updated insurance appraisals, and as a result, the coverage is placed at an amount that's too low. It's $20 million. So we now have a gap between what the coverage is for and what full replacement value is. And the policy has a co-insurance requirement, essentially requiring the strata corporation to maintain at least 90% of full replacement value on the coverage. Where this kind of situation happens, there will be a penalty for not insuring to full replacement value or to that threshold for co-insurance. So as an example here, there's a fire loss in this particular complex of $800,000. And because the strata is only insured to 80% of full replacement, the co-insurance requirement kicks in, and the insurer will only insure to 80% of $800,000 or $640,000 minus any applicable insurance deductible. And ultimately, if they're for that $160,000 that's not there, paid by the insurer, and the deductible, that now falls to the strata corporation and the owners to pay that missing amount. Now, what we've started to see more recently, it's not that it hasn't happened in the past, but it has tended to be quite rare, is what's called a loss limit. And at least in the strata context, loss limits are have been traditionally more commonly arising in the commercial real estate market, where you may have buildings that are hundreds of millions of dollars to replace, and insurance for that would be quite expensive. And there's also some consideration given to the fact that a total loss of a building like that is not necessarily that likely to happen. So instead, the insurer and the insured are looking towards what is a likely or probable scenario for loss and trying to insure to that point. Now, what's happened now in British Columbia, because of limitations on insurance capacity, some policies are being placed that have loss limits, and the loss limits cap the total amount of coverage in the event of a significant or total loss. And again, this is arising because the brokers are not always able to place strata insurance for full replacement value, particularly in larger complexes. Now, where this situation arises, this isn't something that complies with the Strata Property Act, but the Strata Property Act was not written for the situation that we currently find ourselves in. It was written for a softer market or a more evenly balanced market where full replacement value is fairly readily available. So what does that mean in terms of coverage where the loss limit applies? So here's an example. We're back to that same strata that had a $25 million full replacement value for the complex. Coverage is placed at 20 million, or essentially 80% of full replacement value, because the broker has not been able in the current insurance market to secure full replacement value for the policy. So in this case, we have a total fire loss of $25 million. The insurer would pay $20 million because that's the coverage limit or the loss limit for the policy. That will be subject to any insurance deductible that's applicable on this particular policy. But in the event of the same $800,000 fire loss, the insurer will pay the full amount of the fire loss, or $800,000, minus whatever the deductible is on the policy. So there is no penalty in this case as arises in the underinsurance or co-insurance situation. So for many strata corporations, the chances of a $20 million claim, or a catastrophic claim arising is not significant. Again, we don't tend to see complete losses of strata complexes, but obviously we can't rule that out, for example, in the event of a fire or in the event of an earthquake. So what should you do if your strata corporation is advised by your broker that the policy will or may have a loss limit? One place to start is to investigate whether another broker may be able to place to full replacement. Now that can be a bit of a challenge in today's marketplace, where often members of council are hearing at the very last minute whether their insurance is going to be renewed and on what terms. But it is a good idea to start that conversation early with the broker, your broker, to see whether or not they think that there may be capacity issues that may affect your strata's ability to obtain full replacement value, and then consider whether or not there may be options available to your strata corporation to obtain full replacement value through another broker. But you may, after all of that, working both with your broker and potentially talking to other brokers, find out that because of the nature of your particular complex, you're not going to be able to, or your strata is not going to be able to obtain a full replacement value policy. The next step needs to be communicating with the owners to tell them to go and seek their own advice from their own insurance broker on what options may be available to deal with the loss limit situation. Because if there is a total loss, for example, a complete a fire that completely destroys the complex, and there's a loss limit, that means that there will not be sufficient insurance to rebuild the strata the way, or the buildings the way they originally existed. And in the event that there's a decision made not to rebuild, there may not be sufficient insurance coverage for owners to be able to pay out, for example, the full amount that's owing on the mortgage for their particular strata lot. Now, this loss limit situation can work in conjunction with a winding up of the Strata Corporation. So if, for example, the Strata found out that there was going to be insufficient insurance coverage to rebuild the building, it could receive the full amount of the insurance coverage, but then elect to wind up the Strata Corporation and sell off the underlying parcel of land. And that may be sufficient to make up the difference between the loss limit coverage and what full replacement value for the property might have been. So the next area that we're seeing the impact of the hard market is that premiums may increase and significantly. Here's an example, and I would say based on communications with my clients and my own experience, that increases in the realm of what's being presented here as an example, which is here, I think it's close to over 2.5 times increase in insurance premium, is not out of the realm of what's happening. We've seen some stratas, in fact, experience even more than that. Some stratas have been fortunate and not seen that kind of increase. But the reality is we are seeing dramatic increases in premiums, and we're often finding out about it on very short notice. And even when we might plan ahead, trying to think we're going to get ahead of the premium increases, the reality is that the market is shifting quickly enough that the premium information may only be available at the very last minute, and that may limit the Strata Corporation's ability to try and negotiate something with the broker, or to try and see, are there options in terms of coverage? Is there any way that coverage may be adjusted, or to investigate options through other brokers? So how do we pay for the increased premium? As you said, this is happening often on very short notice. You may be finding out weeks and even days before the insurance is to renew. So ultimately, the Strata Corporation's available options largely are going to depend on timing with respect to paying that increased premium. In some cases, you may have anticipated an increase in your operating budget, but it may not be enough. You may be able some Strata Corporations may be carrying a surplus in the operating fund that may help with paying that. Bear in mind that surpluses in the operating fund can only be used for certain things without owner approval, and depending on the circumstances, that surplus that's being carried may require the approval of the owners by a 3/4 vote to use. Many stratas are calling on their contingency reserve fund to pay the unanticipated increase in the premium. That again, the council will have to give some consideration to whether owner approval may be required depending on timing. So the general principle under the Strata Property Act is expenditures from the CRF require a 3/4 vote resolution of the owners, but there are certain exceptions, and one of those is contained in Section 98 of the Act, which allows the Strata Corporation or the Strata Council to authorize expenditures from the Contingency Reserve Fund in what we commonly refer to as the emergency type situation, but essentially it's a situation in which there isn't sufficient time to call a special general meeting to pass a 3/4 vote resolution to approve a CRF expenditure. And there's reason to believe that waiting that 3-week period could result in significant loss or damage to the Strata Corporation, and loss could include financial loss. So obviously with insurance, the need to have an insurance policy in place, the council may have to give some consideration to, can we rely on Section 98 of the Act and the circumstances to allow us to make an expenditure from the CRF. The fourth option may be passing a special levy, and that's some strata corporations not having sufficient funds in their contingency reserve fund are having to look at passing a special levy in accordance or in order to be able to pay the premium. Unfortunately, there's no exception in the Strata Property Act for this one. The Strata Corporation is going to need a 3/4 vote resolution in order to pass the special levy. And then the fifth option is possibly borrowing or financing the premium. The Act does allow strata corporations to borrow money. Again, that requires a 3/4 vote resolution under the Strata Property Act. There is no exception for situations in which strata councils are going to have to make difficult decisions very quickly. My advice to strata corporations and councils that are looking at the issue of how do we pay the increased premium is to get some legal advice about what the strata corporation's options are in the circumstances and what the potential risks are with the approach that may be chosen. With the current insurance market, stratas are having to make some very difficult decisions and are having to make some decisions sometimes that are not strictly in compliance with the Strata Property Act, but the council needs to make those decisions fully aware of what the risks might be if they do go ahead with those decisions. So the next area that we're seeing the impact of the hard insurance market is deductibles. I think over the last few years, even before sort of the crisis that we find ourselves in right now, deductibles had started to creep up, particularly for stratas that had experienced water damage claims. But now with the hard market, we've seen dramatic increases. So in the past, we might have seen a strata go from, say, $10,000 for a water damage claim to $50,000 for a water damage claim. Now it's become fairly common, especially for larger high-rise stratas, to have water damage deductibles of $250,000. Same for sewer backup. We've also seen dramatic increases in some cases for fire claims related deductibles as well. At the end of the day, you need to go and look at the deductibles carefully. And if there is any change in the deductible amount that's on the renewal policy, that's going to need to be communicated to the owners. There's two reasons for that. One, because owners may find themselves the subject of a deductible claim, but also because the increase in deductibles means that there will be more uninsured claims. So just walking through the Strata Property Act and what it says about deductibles, Section 158 sub 1 of the Act says that the deductible that's payable under the Strata Corporation's insurance policy is a common expense of the Strata Corporation. This often gets missed. Where a claim arises and the strata views an owner as being responsible, stratas will often immediately turn to the owner and say, you need to pay that deductible. The reality is the mechanism under the Act provides that the deductible is a common expense, which means the strata pays for it first, and then the strata can look to others, including owners, as provided by Section 158 sub 2 of the Act, to make a claim against an owner to recover the deductible, or a claim against another third party, such as a contractor, to recover the deductible amount. Now, this is the one situation in the Strata Property Act where the Strata Council does not, can you turn back a minute, does not require the approval of the owners to impose a special levy. So if a deductible is triggered and the Strata Corporation doesn't have funds in the operating fund or the operating budget or the contingency reserve fund and needs to pass a special levy, it can do so without a 3/4 vote resolution. And at the same time, for a deductible, not for premiums, all the council has to do is communicate that information via the minutes and a notice to the owners. But the council can also use CRF money to pay the deductible. And again, owner approval isn't required for that. So As I mentioned, we're seeing a lot higher deductibles. The strata, if a significant water damage claim does arise and it's say a $500,000 water damage claim, $250,000 of that would be paid by the insurer, but the strata will have a deductible of $250,000 that it has to pay. That is a common expense of the strata corporation. The strata will pay that up front, but the strata can then look around to see, is there someone we might be able to recover this amount against in the appropriate circumstances. So for the recovery of a deductible amount from an owner, I mentioned section 158 sub 2 allows or facilitates that kind of claim, but at the end of the day, whether the strata corporation can in fact claim the deductible amount from an owner is largely going to be determined by your bylaws. And if your strata corporation has not had your bylaws reviewed over the last couple of years, and in particular, if your indemnity bylaws, your chargeback bylaws, your deductible bylaws, whatever you want to call them, have not been renewed, have not been reviewed recently, I strongly recommend that you get those reviewed. Many strata corporations will ultimately find themselves unable to claim back deductible amounts from an owner because their bylaws don't provide for that kind of a claim. And there are many, many decisions from the Civil Resolution Tribunal that have dismissed deductible claims because the strata corporation didn't have the appropriate bylaw in place to allow that to happen. So I mentioned that higher deductibles mean more uninsured claims. So what this will mean in practice is that the strata corporation will be responsible for repairing any damage to the common property. Now, this does not matter how the claim arose. So even if, for example, an owner's washing machine failed and damaged the common property, the strata will, in that case, still have to repair the common property. It might have a claim against the owner, depending on the strata corporation's bylaws, for the cost of repairing that damage, but it can't refuse to replace the damage and say, no, owner, you have to do it because you're the one that damaged it. The strata always has to repair and maintain the common property, and that includes common property that's been damaged by an owner or by someone that the owner is responsible for. At the same time, the strata may be responsible for repairing damage to a strata lot or damage to limited common property. The extent of that obligation is going to be determined by the bylaws that are specific to your strata corporation. In the standard bylaws, the standard bylaw 8 provides, for example, that the strata corporation must repair and maintain the certain portions of a strata lot, and one of those is the structure of the building. So the structural portions of the strata lot, such as the wood framing or the steel studs if you're in a high-rise building. So if you've got a bylaw that is the standard bylaw or a bylaw that is similar to the standard bylaw and the structure of the strata lot is damaged, then the strata corporation would be responsible for conducting the repairs. Again, it may have the right to claim over against an owner for the damage, depending on the bylaws. Now, the owner will otherwise be responsible for repairing the damage to their strata lot and those portions of the limited common property that are designated for their strata lot as identified in the bylaws. So the first thing when you're dealing with an uninsured claim is to identify what exactly has been damaged and figure out what's in the strata's pile or box to repair, and then what is in the owner's box to repair. And the strata corporation will go ahead and deal with what's in the strata's box to repair, and the strata corporation should be leaving it to the owner to repair the damage to the owner's own strata lot or limited common property as identified in the bylaws. Strata corporations, and I can understand why this happens, strata corporations will often go ahead and repair everything, but then want to try and charge back to an owner all or part of the claim. And in the context of damage that's repaired in the owner's strata lot, we'll say, well, the owner's responsible for the repairing and maintaining their own strata lot. They should reimburse us for that. But it's become clear, based on a lot of decisions that have been released by the Civil Resolution Tribunal, that the strata corporation cannot repair what is the owner's responsibility to repair and charge back, or to repair and maintain, and then charge back the costs without an appropriate bylaw to allow for that, or otherwise it has been agreed to by the owner, and preferably that agreement is going to be in writing. There have been a lot of strata corporations who've taken owners to the Civil Resolution Tribunal to try and recover back amounts spent by the strata corporation in dealing with damage to the owner's strata lot, only to find out that the claim is going to be dismissed because the strata corporation didn't have the appropriate bylaw in place to allow for that. So then the last, or the fourth area that we're seeing issues arising in terms of strata corporations being able to place insurance is targeted towards the perils that may exist in an insurance policy. So at the outset, I mentioned that the Strata Property Act has a list of major perils that the Strata Corporation is required to insure for. But we have seen in some instances where the insurers are saying, yes, we'll place a policy on your particular strata corporation or for your particular strata corporation, but we're not prepared to insure water damage claims or water escape claims because your strata has had a long-standing history of water leaks. There's identified problems in the building that need to be addressed. For example, the water supply system in the building needs to be replaced, and the strata hasn't attended to that. Then the insurer may say, we're just not going to insure for water damage. And so the strata corporation will have an insurance policy that generally complies with the Strata Property Act, other than the fact that there is no coverage for water damage. There may be other instances where the strata corporation decides to elect against taking out in coverage for optional perils. So for example, the strata may traditionally have had earthquake coverage, but that's increasing their premium based on the advice that they're getting from the broker. The strata corporation may elect against obtaining the optional peril coverage, for example, for earthquake. Councils, if you are taking that step, be sure you go back and you look at your strata bylaws. Some strata corporations have adopted bylaws that expressly require the strata corporation to take out insurance coverage for certain kinds of optional perils, including earthquake. If you've got that kind of bylaw, then you're going to have to consider carefully what your options are in the circumstances. And one of those options may be thinking about whether to have the bylaws amended or take it to the owners to have the bylaws amended to remove the obligation on the strata corporation to take out that earthquake coverage. So what happens when you have a situation where a peril is excluded from coverage? So turning now to the next slide, I provide an example of that. So we have a strata that has a water supply system that was identified in the depreciation report as needing replacement. We've had 6 different water damage claims in the last 3 years. The Strata Corporation has tried to pass a special levy for replacement of the water supply system, but the owners have voted it down. The insurer, seeing all of this, now says, we're not prepared to insure your water escape claims, so we're going to take that out of the coverage for your strata corporation. So now we have a water damage claim number 7 that arises after the insurance policy has been renewed. And the strata says, well, we're going to go ahead and fix the damage to the common property and those parts of the strata lot or the limited common property that are identified in our bylaws. And you, owner, you're going to have to go and fix the damage to your own strata lot. What can happen in this case is that the owner may bring a claim against the strata corporation for failure to repair and in negligence, seeking to recover back the cost or the amounts that the owner has spent fixing their particular strata lot. So there is a different kind of risk that can arise when we've got exclusions for a particular peril, particularly one that's required under the Strata Property Act. So now we've had all sorts of negative news or bad news over the last while about strata insurance and the issues. And there are some things that are going to be beyond the control of strata corporations to address, in particular, the wording of the Strata Property Act. It is an issue that is being looked at because by the government, but that's going to be probably a couple of years, or it could potentially be a couple of years to resolve, because there's a lot of factors that go into drafting provisions of the Strata Property Act, and particularly in this case because it also impacts the insurance industry in British Columbia too. So what can a strata corporation do when it's facing premiums and increasing deductibles, increasing, and coverage decreasing? I think the first step is to contact the strata corporation's insurance broker and sit down with them and talk about what are the risk factors for your particular strata corporation. Why is it that your strata corporation is currently struggling with getting full replacement value coverage or any coverage, or why are your premiums and your deductibles increasing? And are any of those factors things that are within the control of the strata corporation? Are there mitigation strategies that your complex could be looking at? At the same time, while you're having that discussion, you could also be looking at, are there parts of the insurance policy that are optional, such as the earthquake coverage that I talked about earlier, that the strata corporation might be able to consider removing from the insurance coverage in order to work towards reducing premiums. Bearing in mind, of course, that that will ultimately have an impact on the owners, and that that in all of that, it may be necessary to consult with the owners about, do we want to be reducing the coverage voluntarily, and what will that mean for individual owners if that is to happen? Often stratas are finding that one of the reasons why their premiums and their deductibles are going up so dramatically and their coverage decreasing or perils being added is because of inadequate repair and maintenance of the building. Strata corporations, for example, that don't have depreciation reports or have outdated depreciation reports, that may be a bit of a red flag for the insurers. But also having a depreciation report that isn't being implemented, in the sense of taking a look at the components of the building that are identified in the report for repair or replacement or maintenance, and that isn't being implemented, and that is translating into insurance claims arising. At the same time, the strata may also want to look at the other kinds of risks that might be arising in your particular complex, and whether or not the changes may be appropriate to allow for dealing with that particular risk. So, for example, in a wood frame building, does your strata corporation's bylaws allow for barbecues? And if so, what kinds of barbecues, and where can the barbecues be used? Because barbecues have in the past, from time to time, been the cause of insurance claims for fire loss, particularly in wood frame buildings. So you've got to take a look at the nature of the risks in your complex from a property damage perspective to try and figure out, are there types of activities that can be restricted or should be restricted, either by bylaw or by rule, and if so, how is that going to be implemented? At the same time, the strata may also want to take a look at whether there are steps that the strata could be taking to try and reduce claims. So to introduce features into the building that don't currently exist. So one example might be there have been a number of stratas that have had water damage claims arising from sprinkler heads being knocked off, or unfortunately being used as a hanger. Other than educating residents about the fact that the sprinkler head can't be touched and that touching it could set off a very significant water damage claim, the strata may also want to look at, for example, putting one of those cages around the sprinkler head. There are also now technologies that allow for water detection, both in common property areas, but in limited common property areas and in strata lots themselves, to identify when leaks are happening in a timely manner so that the impact of the claim is going to be reduced by identifying that there is water leaking when it does happen. And then ultimately, a lot of this is unfortunately going to come down to education of owners and tenants about repair and maintenance and about insurance coverage. Owners and tenants are often not particularly knowledgeable about the components of their strata lot and what needs to be repaired and replaced. For example, I'm starting to see more bylaws that are being introduced that require owners to replace certain components of their strata lots that are problematic from a risk perspective, such as hot water tanks, at certain intervals, and those intervals will be determined based on the anticipated life cycle of the particular component, such as the hot water tank. And the good news is where those bylaws are reasonable, the CRT has enforced them, and that has allowed strata corporations to charge back to owners where they haven't complied, or charge back deductibles or uninsured amounts that have been spent by the strata corporation have been, that has allowed for those kinds of chargebacks with appropriate bylaws. But in connection to that, there may be situations where the strata corporation may not want to just leave it to the owners, and it may be better for the strata corporation to undertake the particular repair or replacement. One example might be washing machine hoses where they're starting to fail. It may be a better risk management strategy to have the strata corporation undertake a replacement of all of the washing machine hoses in the strata corporation and replace them with braided hoses, same with the hoses underneath the toilet tanks, as a risk mitigation strategy. Knowing that although you can adopt a bylaw that says an owner must replace the washing machine hose with a braided hose, or the hose under the toilet tank with a braided hose, that requires enforcement. And there's not an unreasonable likelihood that one or more owners may not comply with the bylaw, and that insurance claims or water leaks may still arise as a result of that. So I think the biggest thing that I think stratas can take out of all of this is that there needs to be a greater focus placed on identifying ways to try and reduce claims in your strata corporation, and in educating owners and tenants about those risk mitigation strategies. To this point, with lower premiums and lower deductibles, there hasn't been the same kind of incentive on the strata corporations and the owners and the tenants to take the steps that are necessary to try and reduce insurance claims. But I think we're all finding out now that's become a necessary step for strata corporations to take. So I've now reached the end of the sort of formal presentation. I know questions have arisen. I can see the Q&A arising, so I'm going to let Tony, because I think he's probably been monitoring the questions, let Tony identify questions that we can discuss and answer.
That's great. That's super, Alison. Thanks so much. Yeah, I've kind of grouped them into 8 questions that all seem to kind of layer over the others. So let's go through those. So the first question is, how do we manage the situation when our broker only gives us our quote and options the day before our policy renews? Is there anything we can do about that?
Well, unfortunately, I've often used the phrase over the last few months, you can't get blood from a stone, and you can't get insurance coverage where it doesn't exist, and you can't always get information where it doesn't exist. But I would say be persistent, and even if your broker can't give you specific information about your policy, because of the fact that they are getting the information in so late, you can ask about general trends in the insurance industry, what they're seeing with other stratas that they're renewing, what can you anticipate, are there risk factors that you should be taking into account, like is there a bigger risk that your strata, because of the size of the complex, is going to have a loss limit. And also start talking to potentially other brokers who place strata insurance to see if there is a potential backup option for your strata if your current broker isn't able to place you at the very last minute. But I think it's trying to strategize about, well, planning, knowing that the information may be coming in late, and trying to investigate whether there may be other options available. And also, quite frankly, keeping the owners in the loop and letting owners know about what the delays are, and the fact that they may be advised that they're going to have to go to their own brokers, their personal brokers, to try and place insurance coverage to the extent that it's available in the market on the individual level to supplement what the Strata Corporation is ultimately able to obtain.
Well, and I think the other part is we're comfortable historically and also through our auto insurance in the province that it just automatically renews. Yeah. And so we've never really thought about this, but really 30 days before, we need to be picking up the phone and talking to our insurance broker and developing the relationship and finding out what's going on and what they can do, and looking at our claims history and everything else that may somehow impact our renewals, and stay communicated with your broker and don't wait till the last minute, which is a challenge I think that people are really having.
Well, and once you do get your renewal, you may be getting some bad news when your renewal comes in. Once you got that, you do need to be going back to your broker and saying, okay, we saw the bad news this year. What can we be doing now to try and have some better news next year, even if the hard market's still in place?
Exactly. Isn't a appraisal required every year? Can a strata corporation select their own appraiser? And the reason this got raised is there's a concern that there's a potential of conflict of interest between an appraiser and a broker. Now, they act independently, and our experience has been that it's up to the decision of each strata corporation which appraisal company they're going to hire.
Yeah, that is an individual decision of the Strata Corporation. I've certainly not been aware of brokers directing stratas to obtain an appraisal through a particular appraiser, and I don't think that that's a good idea. I think stratas need to get their own professional advice about things like appraising the strata complex, and there are a number of appraisers out there who do this work on a regular basis, so it's not like there's a limited market for that. And I'm sorry, I've forgotten the other question.
Do we require an appraisal every year?
Yeah, sorry. The Act does not mandate a particular frequency to obtain the insurance appraisals, but I think it's good practice to obtain an insurance appraisal regularly, because if you don't, then you could run the risk of not having full replacement value if you are on a full replacement value policy, and running afoul of the co-insurance clause. How frequently is largely going to be a factor of what the construction industry is doing at a particular point in time. Are prices increasing dramatically? But the reality is it's pretty easy to be on a program. Many of the insurance appraisers who regularly do strata insurance appraisals will have a program where they do, for example, a report in year one. That's a full detailed report. And then in year 2 and 3, they will just provide update information, subject to anything that the Strata tells them about some major project being undertaken. So if you're on a 3-year program, it's pretty easy to have your insurance updated regularly. And in the scheme of things, your insurance appraisal costs are going to be a fraction of what your premium is going to be, and will likely be a fraction of whatever the impact of a co-insurance clause is going to be. So it's money well spent to be getting your insurance appraisal done on a regular basis. And in most cases, that likely means every year for the report or the update on the report.
Thank you. So the next question relates to what happens if our strata is not insured and we could not renew our insurance. And we had a question that related to that might help this make this easier. Our building is being denied insurance because of aluminum wiring. Would it resolve the problem if an electrical engineer were to specify upgrade requirements, we had the work done, and certify our site as safe?
Well, I can't speak for the insurance underwriters, but if that's the reason that's being given, which is that the electrical system is creating a significant fire risk for the Strata Corporation, I guess one, does that mean that you can't get any insurance coverage, or should it be limited to fire loss only? I guess that's one area to investigate. But assuming that the insurers are not prepared to insure at all, then I think that's the conversation that you'd be having with your broker about, if we go ahead and fix this, which sounds like if that's the reason that's being given, then that should be, if it's resolved, no longer the reason why you can't get insurance. You should be able to place your insurance at that point. But again, that's a discussion you need to have with the broker about what steps should be taken to deal with the risks that have been identified for your particular complex.
In the same vein, there's a question here relating to a Richmond strata that have been denied insurance because they're in a high earthquake zone with a high risk factor. And so they're given the indication that there's no action they can take to increase insurance, but earthquake is an optional peril, and they could actually write a policy without earthquake coverage and just go to the base coverage for the building under the requirements of the Act.
Yes, and in that case, then the Strata would need to make it clear to the owners that the policy that's been taken out by the Strata Corporation does not extend to earthquake, and that owners should be looking at their own insurance policies to see if, and talking to their own personal brokers to see if they are able to get earthquake coverage where the Strata Corporation is unable to. It may be that they can't, but the Strata does need to at least convey that information to the owners that the Strata's policy does not have earthquake, because many owners, and in fact many people generally just assume that earthquake is a given and it will always be in the Strata's insurance policy, whereas in fact the Act does not make it a mandatory coverage for this reason exactly, which is that some parts of the province it's harder to obtain earthquake coverage than in other parts.
And I think one last question, as we're starting to layer over questions on the others. Is it appropriate for a Strata Corporation, if they have a claim, is it appropriate for a Strata Corporation to consider paying the claim as opposed to simply filing an insurance claim to basically avoid increasing their claims history resulting in future insurance costs?
Well, I think you have to be really careful about making the assumption that not reporting the claim as an insurance claim will necessarily have the impact that you think it will, depending on the application that has to be filled in each year and the questions that are being asked by the insurer. You may still be required to disclose water damage claims that arose, or water damage incidents that arose, even where they have not been reported on the insurance policy. And at the same time, depending on looking at your insurance policy, you may have an obligation to identify material changes in the risk that the insurer is undertaking. So depending on the circumstances, there may still be a positive obligation to disclose, for example, that it's been identified that the water supply system in the building needs to be replaced or something like that. So be careful about that assumption. That being said, yes, we've seen a lot more instances as deductibles have increased where the benefit of the insurance is pretty limited. So as an example, you might have a claim, a water damage claim for $28,000 and a $25,000 insurance deductible. So the Strata, if it made a claim, would only be getting $3,000, potentially $3,000 worth of insurance coverage. Is that, can the Strata in that case make a decision not to make the claim against the Strata's insurance policy? I think the council does have that authority within some limitations. Remember, at the end of the day, the Strata Council can only spend money in accordance with the Strata Property Act. So you're going to look carefully as to whether the Strata Council has the authority either under the operating budget or under the contingency, spending money out of the contingency reserve fund to do that. So again, this is one of these circumstances where I'd be recommending getting legal advice. And the Strata also has to be careful about spending the Strata's money to repair an owner's Strata lot where the Strata has no obligation to conduct that repair. Ultimately, I agree that not making the claim on the Strata's insurance policy may be a benefit to all of the owners on the one hand, but at the same time, the Strata Corporation is still governed by the Strata Property Act and still has to, the council still has to ensure that its authority is grounded in the act when it's making decisions like that.
Super. Thanks so much, Allison, for joining us today. By all means, if anyone has any additional questions, they are welcome to email us directly. And if your building is not insured or you're having difficulties with what you're dealing with insurance, you can email me directly. I'm very happy to help you out. We're working with a very large list of brokers. We're working with the Insurance Bureau of Canada, the Insurance Brokers of British Columbia, and we have weekly meetings with financial services and the provincial government, looking at what all the options may be as we go forward and try to get some a bit of the pressure relieved off of this industry, as we're every one of us are struggling with our own insurance policies in our own buildings as we're going through these increases. This presentation will be posted to the CHOA website tomorrow. Thanks to BFL Canada for sponsoring this event, and thanks so much to BC Housing, who are our ongoing corporate funding partner. So we will stop the video at this time, and I'll continue on dealing with Q&As online with people.